Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about HERC Holdings INC quarterly report. HERC Holdings Inc. offers a diverse range of businesses and services to various industries worldwide. The company's primary offerings include equipment rental services for aerial, earth-moving, material handling, trucks, and other specialized equipment. Additionally, HERC provides solution-based services such as power generation, climate control, and remediation through its ProSolutions platform. The company also offers a range of professional-grade tools and contractor supplies, including construction consumables, safety supplies, and small equipment. Its services extend to equipment management, repair, maintenance, and safety training, as well as on-site support and re-rental services. HERC's customer base spans various sectors, including non-residential and residential construction, industrial manufacturing, infrastructure, government, commercial facilities, education, healthcare, data centers, hospitality, retail, and special event management. The company sells its products through a combination of sales teams, industry catalogs, trade shows, and online platforms. Key services offered by HERC Holdings Inc. include equipment rental solution-based services, ProSolutions, professional-grade tools, ProContractor, contractor supplies equipment management, repair and maintenance, safety training, on-site support and re-rental services, ancillary services, equipment transport, rental protection, cleaning, refueling, labor. HERC Holdings Inc. Stock price drop. A multifaceted issue, the significant drop in HERC Holdings Inc.'s stock price by 33.05% in the past year can be attributed to a combination of factors. The company's earnings misses, substantial acquisition-related costs, and increased debt, ongoing macroeconomic headwinds, and valuation concerns have all contributed to this decline. Earnings misses have been a recurring issue for HERC Holdings, with 4 consecutive quarters of disappointing results. The company's inability to meet analyst expectations has led to a loss of investor confidence. Additionally, the substantial acquisition-related costs associated with the H&E Equipment Services deal have put pressure on the company's finances, resulting in increased debt and higher interest expenses. Macroeconomic headwinds, including a higher-for-longer interest rate environment, have also impacted HERC Holdings' performance. The weakness in local account segment has affected overall volume growth and margins, further exacerbating the decline in stock price. Valuation concerns have also played a role in the company's stock price drop. Analysts have noted that HERC Holdings' price-earnings ratio is high compared to the industry median, leading some to consider the stock overvalued despite its revenue growth. Overall, the decline in HERC Holdings Inc.'s stock price can be attributed to a complex interplay of factors, including earnings misses, acquisition-related costs, macroeconomic headwinds, and valuation concerns. The primary drivers of revenue growth or decline can be summarized into 3 key areas: equipment rental revenue, acquisition and divestiture activities, and operational efficiency. On the growth side, a significant increase in equipment rental revenue, driven by higher sales of rental equipment and other rental revenues, contributed to a 29% growth in 3 months. The acquisition of H&E Equipment Services, Inc., for $4.8 billion also played a crucial role in revenue growth. Additionally, an increase in average OEC on rent led to a 30% growth. On the decline side, decreased profitability, driven by transaction expenses and acquisition disruption at H&E, were major contributors to revenue decline. The divestiture of Cinelise also had a negative impact on revenue. Overall, these factors demonstrate that revenue growth or decline is largely influenced by strategic business decisions, operational efficiency, and market conditions. Net income and profit margins. A decline in performance. The financial performance of a company has taken a significant hit, with net income plummeting from $257 million in Q3 2024 to -$23 million in Q3 2025. This represents a staggering decrease of $145 million year-over-year. The decline is also evident when looking at the 9-month period, where net income dropped from $257 million in 2024 to -$23 million in 2025. Profit margins have also taken a hit, with operating profit margin decreasing from $334 million in Q3 2024 to -$16 million in Q3 2025. The gross profit margin is implied to be decreased as well, although the exact figure is not provided. The reason behind this decline in performance can be attributed to increased transaction expenses and additional interest expense payments related to the acquisition of H&E. These costs have significantly impacted the company's profitability, leading to a substantial decrease in net income and profit margins. The company is indeed generating positive operating cash flow. According to the financial summary, it has consistently produced significant amounts of operating cash over the past 2 years. Specifically, for the 9 months ended September 30, 2025 and 2024, the company generated $770 million and $894 million in operating cash flow, respectively. This trend indicates a stable and healthy financial position for the company. The company's debt level and interest expenses have undergone significant changes in recent years. Debt level. The company's debt has increased from $4,069 million to $8,164 million, a rise of $4.1 billion. This increase is primarily due to the issuance of new debt facilities, including senior unsecured notes, term loan facility, and asset-based revolving credit facility. However, some of this increase was offset by the extinguishment of H&E debt not assumed as part of the acquisition. Interest expenses. The company's interest expenses have also increased significantly, from $69 million in 2024 to $134 million in 2025. This represents a rise of $31 million, or 45%, and is largely due to the new debt facilities, with a weighted average effective interest rate of 6.8%. Management's outlook on company strategy. The company plans to grow through strategic transactions and is well-positioned to operate effectively in the current economic environment. They aim to expand their customer base by offering products that serve different industries with less seasonality, ensuring a more stable business cycle. The acquisition of H&E is expected to bring benefits, but realizing these synergies is subject to various risks and uncertainties. Management is confident in generating positive cash flow from operations and having sufficient liquidity to meet working capital requirements over the next 12 months. Overall, the company's strategy focuses on growth through strategic transactions and expansion into new industries with less seasonality. The company made 2 significant financial transactions in 2025. Firstly, it acquired H&E Equipment Services, Inc., for a total purchase price of $4.8 billion on June 2, 2025. The acquisition was made through a combination of cash and stock. On the other hand, the company divested its Cinelli Studio Entertainment business for an initial cash consideration of $100 million on July 31, 2025. These transactions demonstrate the company's strategic approach to growth and optimization of its portfolio. The company has a history of paying dividends to its shareholders. Specifically, it declared a quarterly dividend of $0.70 per share in August 2025, with the payment date set for September 5, 2025. While share buybacks are mentioned as an option for capital allocation priorities, there is no explicit confirmation that the company has actually bought back shares. That concludes the financial summary for HERC Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.